In this video for the members, I show them exactly why I'm buying QDTE and QQQT. What's most important is not the fat dividends they pay. It's how they derive their dividend. And what I'm going to show you and the members, it's very important how these new high-yielding dividend stocks and ETFs pay their dividend. I give you an example in this video, and what I want you to do is do your due diligence. Always understand how they derive their dividend. In the description below is the offer to my membership. Every single trade that my members see, in and out, they get to see what dividend stock I'm buying with those covered call profits. Hell, I did it today. We buy all the dividend-paying stocks that you see here on my YouTube channel. QQQT, SPYT, YMAX. I can go down the list of some 13 dividend-paying stocks that I buy, and I'm collecting over $22,000 a month. I'm in retirement. I write covered calls, sell cash secure puts. I take those profits and buy dividend-paying stocks, and I live off of that passive income. You can too, but it all starts with understanding how the dividend-paying ETF derives its dividend so you don't find yourself in a situation where you're regretting it because these high-yielding dividend-paying stocks will absolutely fall because they're paying such a huge dividend, and you might not understand why. So, with that said, I'm going to turn it over to him. He's going to show you exactly why he's buying QDTE and QQQT. Stick around. I know you're going to like this one. Hey, welcome back, everyone. It is time for another dividend-paying stock breakdown. Today we're going to talk about two of them that I own, QDTE and QQQT. We're going to break these down because more and more companies are coming out with all these dividend-paying stocks, and they're all using the QQQQQ. You get it, right? It's alphabet soup with the Qs. Let's break these two down because I have been buying these two, and I'm going to continue to buy these two for the reasons I outline here today. Now, I want you to do your own due diligence. This is probably going to get you to the 10-yard line, if you know what I mean. I'm going to have you go out and do the rest of your research. We're investing real money here. This is real money I'm investing in these two dividend-paying ETFs. Let's go ahead and talk about QDTE, QQQT, the differences. But more important, I always say this. You have to know how a company such as Roundhill or Defiance derives its dividend. If you do not know how a dividend-paying stock derives its dividend, you need to stay away until you understand that. I always use this example because this is absolutely the number one thing you need to know. How do they derive their dividend? I use the horsewhip analogy. If ABC dividend-paying stock used horsewhip sales to pay a fat dividend, that was great about 100 years ago. If XYZ dividend-paying stock uses oil and they pay a little dividend, let me ask you a question. Which one is more sustainable and which one will be long-lasting? It's not going to be the horsewhip dividend-paying stock. You have to understand what's inside these things, how they derive their dividend. Then, and only then, should you be investing in them. Because these days, these things pay so much money per share, these things can fall. And what I mean by that is they fall based on their dividend distribution, and that can be a lot. And if these things are $20, over the course of a year, these things can lose half their value, and you're wondering what the hell happened. Well, that's where you need to understand how they derive their dividend. Let's break these two down. So we're going to start with QDTE. Now, this is a Roundhill ETF. They're going to use the NASDAQ, and it's 1X. The reason I mention that is because there's so many ETFs that are now leveraged, such as a 2X leverage, 3X leverage. These are single leveraged ETFs. So we ask the question, how does QDTE derive its dividend? They're going to use call options on the NASDAQ. I'm going to explain this in the next slide. They have a dividend. Of course, they wouldn't be on this presentation if they didn't. They provide weekly dividends. So you will be getting a weekly dividend check with QDTE. Now, their last dividend was 25 cents per share. So if you own 1,000 shares, you're going to collect $250 for that week. They distribute their dividends weekly. Now, chances are you get that dividend on Monday or Tuesday of the following week, but they distribute those dividends weekly. When we look at QDTE's dividend, we could see that it's a weekly dividend payer, but we're going to look at this in a 30-day window because we're comparing it to QQQT, which is a monthly dividend payer. And you could see over the past 4 dividends, QDTE's collecting $1.25 for the entire month. 4 weeks ago, 39 cents. 3 weeks ago, 44. 2 weeks ago, 19 cents. This past week, 25. That's $1.25 a month. That's actually a lot of money. Because remember, when they distribute the dividend, that amount comes out of the share price. It's very important you understand that. Now, it has options. Now, I see a lot of people out there trying to use options with dividend-paying stocks, and there's only a handful that you could truly do this with, largely because they have no volatility. And when they have no volatility, nobody's going to be doing options on them. Most people who own the shares will do a covered call, probably an at-the-money covered call, and typically what happens is the ETF will move a little bit higher. They have their shares taken away, but that covered call premium would represent, I guess, the dividend they would have collected. Or if that dividend-paying ETF were to fall, then maybe they keep their shares, they keep that premium, and they collect the dividend. It's a little bit of a game, but what I'll tell you is options on these dividend-paying ETFs pretty much nil. I would suggest to anyone, if you wanted to write covered calls, you would pick other ETFs, generate more income, and then buy these dividend-paying ETFs. It's a strategy I use, and I will continue to use it. We write covered calls on other index-based ETFs, leverage them up 3x. We do it. We generate fat premiums. Those premium profits get dumped into these 2 dividend-paying stocks. That's how I do it. Now, let's get back to this. The net asset value is basically what people invest in these things. So you can see QDTE has $346 million involved here. So that's a big one. Now, there's bigger ones, of course, but compared to QQQT, which hasn't been in the game that long, you could see its NAV is only $12 million. You need to really compare SPYT to QQQT because SPYT has been out just a little bit longer, and it basically is what the QQQT is, but one uses the S&P, the other uses the NASDAQ. So that is QDTE. We're going to talk about how it derives its dividend next, but let's go through QQQT real quick. We got the monthlies. They use the NASDAQ as well. It pays a monthly dividend of 32 cents. Now, with QDTE, they pay weekly dividends. Those weekly dividends, you're getting them per share per week. With QQQT, you're getting a one-time payment, and their last dividend was 32 cents. And the idea here is you have a diversified portfolio, and you might have weekly payers and monthly payers and quarterly payers of dividends. So they too, QQQT has options, but again, there's no volume and there's not many offered. So you're really not going to use either one of these for writing options against. Okay? That's an interesting thing because both of these use options to derive their dividend. So now let's talk about how these 2 derive their dividend. So you have to understand options to get this. If you don't understand options, you are not going to understand this. Let's talk about QDTE. QDTE is a company, Roundhill, and they have a room of options traders. And what they do is they buy call options and they write out of the money calls with expirations being daily. So I'm just going to give you a hypothetical. Say, for example, they bought the NASDAQ, and the NASDAQ cost $100. What they're doing is they're writing out of the money covered calls on that NASDAQ position, and it might be the 105 strike, right? They got it at 100, and they're going to sell it for 105. They collect a premium. Typically, the NASDAQ won't go to 105, so because it's daily, time decay enters, and this 105 option will expire worthless, which means they keep the premium. Now they wake up the next day and they do the same thing. So for those that don't understand covered calls, you basically have an asset, right? You have a stock, an ETF, and you're going to buy that. You're going to take a position in that. You're going to give somebody the right, but not the obligation to take that away from you at a price I pick, right? And I give them a time frame. And if they want to buy my shares at a price I pick and a time frame I pick, they're going to pay me a per share premium for that right. Now, regardless of why they want to buy my shares at a price that I pick for a time frame I pick, doesn't matter. They're going to pay me that covered call premium. Well, QDTE goes out and it buys call options. It gives them the right to then write a covered call as if they own the stock. Now, you may or may not understand that, so let's try to focus here. They call that a non-traditional synthetic trade. They are creating a position for which it simulates real stock ownership, but they actually don't own the shares. But they can do this by buying call options and then writing out of the money or selling out of the money call options against that synthetic position, and they make a premium. Now, because this is daily, that time decay and that premium is going to fall quickly, so they keep all that premium. They do this every single day. So that's why time decay is a benefit to QDTE. And what's another benefit is they're selling out of the money covered calls. So they typically don't have that synthetic trade ending. They're putting that near-term daily covered call strike price out there just enough so they don't have their synthetic trade interrupted. See, they're probably going to use those call options that created the synthetic trade multiple days and multiple weeks, if not multiple months. So with that said, that team that does this, they're going to collect a 0.95% fee, and that's priced in daily. It's not 0.95 every single trade. It's going to be split up. That's more of an annual expense ratio. Now let's talk about QQQT and how it derives its dividend. I started this by talking about how QDTE uses a non-traditional synthetic or simulated trade to write covered calls against. QQQT actually goes out and invests in ETFs that invest in the NASDAQ. I'll give you a basic idea. Imagine ETFs out there trading the NASDAQ. Well, the team at QQQT goes out and buys those various NASDAQ ETFs. What they're going to do is they're going to buy them and hold them, and then they're going to write covered calls against them. Here's what they do to generate their dividend. They basically use call spreads, and what they're going to do is sell at the money or near the money covered call spreads to retain upside growth potential, because what they're also going to do is buy a call option. So if the stock were to go above their strike price, then their call option that they buy will make money. So let's recap that. They go out and buy NASDAQ related ETFs. They actually hold the asset. That's a very traditional way buy right closed end funds will generate their dividend. What they're going to do is then write covered calls on those ETFs at the money to make max premium per share. Knowing that the NASDAQ could go higher during a given month, they want to capture some upside. So what they do is they buy an out of the money call option. So as the stock moves above their covered call strike price, for which they limit their upside, although they collect the fat premium, they don't make any money on the ETF actually moving higher. They're making money on the call option that they bought. They call that a credit spread. And this is what QQQ does to derive its dividend. They're both using covered calls, and they both have different strategies. Remember, QDTE uses the out-of-the-money daily covered call, and QQQT uses an at-the-money weekly covered call. Both of them use time decay to their advantage, because when they put these trades on, they're doing them either for a day or a week. If you know what time decay is when it comes to options, that's when time decay erodes the quickest. So these ETFs can generate a lot of money and distribute a lot of money per share to its shareholders. Now, before we move on and have you go out and do your due diligence, let's look at each one of these charts. We're looking at QQQT here, and you can see it has not been around that long. Its inception was around July, and it was sold for 20 bucks. You can see that it's holding its value. It's trading for about $18.80. It holds its value and pays a decent dividend because it actually buys the ETFs for which it writes covered calls on, and because it can capture some upside when the ETFs that they're trading go higher, they could actually make more money. So this is a nice, easy swinging monthly dividend paying stock that's going to pay you about 32 cents. And that's what I love about this. 32 cents is a sweet monthly dividend per share. Because if you're old school like me, where you've invested in buy rate covered call closed-end funds where they paid 9 cents to 15 cents to get anything in the 30 cent, 40 cent, and 50 cent range is absolute wonderful. So I love QQQT. You could expect that if the NASDAQ trades sideways to higher, this will probably trade in this range. And every single month, you'll get that 32 cents knocking it down. Looking at Round Hill's QDTE, you can see it acts very similar to how QQQT was, because that's how the NASDAQ has been trading recently. Notice its dividend distribution is weekly. Many more dividends, and a lot of people like that. They want to collect those weekly paychecks. Well, it trades the same. You could also see that when the NASDAQ was moving much higher, it was moving much higher. And then, of course, when it ripped lower, where we had NASDAQ days down some 1,000 points, well, this, basically being a NASDAQ trader, felt the pain. But you could see, as the NASDAQs recovered, so it has. And again, this is going to pay about 20 cents a week on average. So if you're asking me which one I like, absolutely love QQQT. I love that easy swinging 30-cent dividend play, and I can bank on it. So I'm going to write a lot of covered calls on a bunch of other stocks like TQQQ, TNA, Yin, and all of the other various stocks and ETFs I trade. I'm going to take those covered call profits and I'm going to buy these two ETFs because I'm generating massive amounts of weekly and monthly dividends just by buying and holding these two dividend paying stocks. Now I also have QQQY and QYLD, and those two will be featured in an upcoming video where I'm going to break those down and how they derive their dividend. Always remember, golden rule number 1 with dividend investing, understand how they derive their dividend. If you do not understand how they derive their dividend, you absolutely need to sit on the bench, do your homework, and only invest when you truly understand how they derive their dividend. Because had you gotten involved in a dividend-paying stock like ULTY at $20, and they have been paying over $1 a month every single month, and now your investment's $10 and you don't understand how you've lost 50% of your value, well, you didn't do your due diligence. That's exactly what it is supposed to do if you're an income seeker. But I'll tell you what, I see a lot of people freaking out on the internet because they didn't understand it. Now their investment is down 50%. And all I could do is just offer them up. Do your due diligence before you ever put risk capital in the market. Hey, look, be safe, be healthy, most important, be lucky. Until next time, may all your covered calls be profitable.